So we're coming to our final two sections for this lecture. The penultimate, or the second last, will be about savings, wealth, and capital. And the final one, we're going to very briefly talk about labor market measurement. So first I want to talk about the difference between the concept of a flow and a stock. So using the examples we've talked about, recall that GDP and all its components are measures of economic activity for a given time period. Because it's for a given time period, we call such rates per unit of time a flow. So in other words, this is the amount of income that is flowing to me, say, in a given time period. Or it's the amount of income that is flowing to the economy in a given time period. This is different than a stock. So a stock is a quantity of an object at a given time. So for example, wealth is a stock. Now the easiest way to think about the difference between a flow and a stock is to think about water. So water flowing in a river into a river basin. The flow of the water into that basin at any point of time is a flow. We could express it as number of milliliters of water per minute, for example. The amount that's accumulated in the basin is the stock. We would express that as a volume, not a volume per unit of time, but as a volume. So for example, a total amount of liters. And so the same is true of income and wealth, or savings and wealth. Every time I save, that's a flow. It's a flow of income into, say, my bank account. And the stock is the amount of wealth, or say the amount of money, that is in my bank account. So that's the example I have here. The money in your bank account today is a stock. The total amount of money which you deposit or withdraw is a flow. So one is expressed as a change over time, and the other is an amount at a given time. So let's now talk about our concept of savings and of wealth at the aggregate level, at the macroeconomic level. So here's some definitions. First, we call private disposable income YD. And this is just total income, so total GDP, plus the amount of money we receive as transfer payments from abroad. That's NFP. Transfers from the government. So you might imagine I get a COVID-19 payment. That's a transfer from the government. That adds to my personal private income, plus interest I might earn on government debt, minus any taxes I pay. So you can think of this as this is the income I have available to spend on stuff, to use to consume, for example. So that's why we're subtracting taxes, because anything I pay in taxes, I can't use to consume. But anything I get as a transfer from the government, again, for example, as a payment because of COVID-19, I can use that to spend, to consume. So this is the amount of income I have available to me to consume. And then you can think about aggregating those across all individuals, and that would give you YD. So that's private disposable income at the economy level. And then that gives rise to private sector savings. So now this is the flip side. This is everything I earn minus everything I spend, or everything I consume. So that's just YD minus C. And so we can expand that. We can use our definition of YD and then minus everything I consume. So when you subtract what I use for consumption, everything else must be savings. If I'm not using it to consume, I'm using it to save somehow, to build my stock of savings. So recall that this is a flow. All of these variables are flows. They're units, they're measurements of a flow over time. So a flow of savings or a flow of income. Likewise, the government saves, right? So the government receives taxes, and then they pay transfers, they pay interest on their debt, and they make government spending, or they spend. And the difference between those two is their saving. You could also think of this as the government deficit or the government surplus in a year. Again, this is a flow. Now, if we combine these two, that's what gives us national saving. So this is now national saving, S, is equal to private saving plus government saving. So let's just plug in all the stuff we have here. So savings then is just equal to, this is total income minus consumption minus government expenditure. So if you had plugged in the two expressions here, you'll notice that taxes and transfers and interest cancel out. So that's why they don't appear in this line. Plug in now our equation for GDP. So consumption plus investment plus government expenditure plus net exports plus net factor payments minus C minus G. And you can see we still cancel some things, or we cancel some things. So our consumption terms cancel. Our government expenditure terms cancel. And we're left with the following, which is that savings is equal to investment plus net exports plus net factor payments, or net transfer payments from abroad. And in fact, those two we define as CA, which is the current account, surplus or deficit. So when it's greater than 0, we call this a current account surplus. When it's less than 0, we call it the current account deficit. And so we're left with savings, national savings, or savings in the aggregate, is equal to investment plus current account, the current account balance, whether it's positive or negative.